Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Welcome to The Bigger Picture. Me, Ryan Huang. Recent months have highlighted factors that could drive greater interest into geographical diversification. And we've got evolving US policy dynamics, regulatory uncertainty, and much more, which is perhaps prompting investors to reassess their concentration risks in their portfolios. So what should they be looking at more closely? Let's check in now with Guan Yi. She is the Head of Asia Fixed Income at M&G Investments. Guan Yi, how are you doing today? Good morning.
Good morning. Happy Friday.
Happy Friday. Well, markets seem to be doing quite okay these days. Interestingly enough, a bit counterintuitive for some. What do you make from the latest you've been seeing in the past year or so, in the past 6 months?
I would say coming into this year, everyone was generally cautious or even concerned about the outlook for Asian asset prices. I mean, we were very likely heading into a trade war, and in fact, you can say that the Liberation Day announcements in, I think, April 3rd it was much worse than everyone expected. But instead, 2 months on, we are looking at stronger Asian currencies against the dollar. We are looking at lower Asian bond yields. We are looking at higher Asian equity prices. So that's the interesting part about markets, right? You have your expectations and your forecast, and the reality can pan out quite differently.
Yeah, so it's almost like a tale of two halves. So what is the second half going to be holding for markets? Are we looking at a better second half?
Given that, we have passed the worst of the trade announcements, and in fact, this morning we are opening to, U.S. Reporting that, they have negotiated agreements with China and more trade deals are coming up soon. It does sound, quite positive for the second half, but I think the economic reality might take some people by surprise. I think one reason why Asian currencies and Asian equity markets have done better than expected year to date is because, we actually had a lot of front loading of export. Basically importers in the US, were worried about, the higher import cost prices, and they were actually front loading their export orders. And Asia, given, we are a big provider of goods to the US, we benefited a lot in the first half, from this front loading of exports. I think clearly there is going to be payback in the second half. So the businesses, particularly the exporters, I think they are already aware of what's coming. So if you look at new export orders, that's already falling. Business sentiment feels rather weak. If you look at lending data across Asia, that has softened in all countries. So the economic reality is second half might be considerably weaker than the first half. That's going to be negative for sentiment. But having said that, the removal of uncertainty due to Trump's trade policies, I think that probably can help to offset that a little.
Okay, so we talk about the evolution of the portfolio where global investors are looking to diversify and perhaps rotate away from US exposure. Do you see that continuing? What have you seen this year, and what's going to be happening in the coming months?
I think the big surprise this year is that the dollar has actually weakened rather than strengthened. This unexpected weakening of the dollar, and in fact, by a rather large magnitude, is causing asset allocators globally. Basically outside the US, the Europeans, the Asians, to really start thinking about, should they be having so much exposure to the dollar? Now, the last 5 to 10 years, was a period of dollar exceptionalism. U.S. stock markets did better than everyone else. The U.S. dollar appreciated, through the most part of the last 5 years. Now, so investors in Europe and Asia, right, had been very comfortable continuing to invest in the U.S. and to keep their U.S. dollar exposure unhedged. But given this turn around in the dollar on the weak side, they are now, really considering whether that is still the right exposure to have. I mean, there has been a lot of talk over the last 3 months, but asset allocators typically don't move so fast. I think this is we are just in the beginning of this reallocation trend, and it should have more to play out, particularly, like I say, as uncertainty starts to reduce.
Okay, so more of this to unfold perhaps. So where is this going? Where are the flows going in terms of geographical markets? So where are the Asia bonds that are standing out for you more in that case?
In Asia, the big markets will definitely benefit first. So this will be the Korean bond market, for example. We have seen strong inflows into the Korean bond market actually all the way since last year. other bond markets in Asia that have benefited Singapore. Not a very big bond market in relative terms, but because of our strong sovereign rating, we are the only AAA in Asia and one of the few remaining AAAs globally. Singapore government securities have also seen strong inflows. I think once uncertainty, because it's very hard for global asset allocators to rebalance their portfolios when market volatility is so high. Once this volatility stabilizes, and in fact, we are now talking about rate cuts in the US. This, I think, will propel global investors to start looking at other bond markets in Asia, say Indonesia, India, Philippines, Malaysia.
Okay, how about the corporate side? When you look at corporate bonds, what stands out for you?
Most investors in Asian corporate bonds will have complained, for the last few years that, credit spreads are very tight, meaning, you aren't really paid a lot in pickup to invest in corporate bonds versus government bonds. I think this situation is likely going to continue. Firstly, we have had 3 years now, 3 years of reducing corporate bond supply. So, the reduction in supply, while the demand continues to increase, that will only cause spreads to continue to tighten. And in the meantime, while we are looking at the slowdown I mentioned in the second half, Asia continues to grow at faster rate than Europe, for example. So this means, the corporate companies, that their financial fundamentals will continue to remain stable and resilient.
Okay, so a rather resilient outlook still for Asia in view of what's playing out despite all the uncertainties. And helping us unpack that this morning has been Guan Yi. She's the head of Asia Fixed Income for M&G Investments. Guan Yi, thank you so much for your time this morning. Have a great weekend in advance.
Thank you. Happy to be here.
All right, catch you again next time.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.